Hi all, my name is Professor Richard Harrigill. I'm an adjunct professor here at Northwest University in Kirkland. Today's video we're going to talk about bonds. And bonds is a major way that corporations raise money for their operations. When a company needs to bring in funds, they typically can do two major things. They can sell equity or they can incur debt. Equity is when they take a little piece of the business and give ownership away to the investor. They do that in stock. When you buy a share of stock, you're buying a small little sliver of ownership of the company. So they'll take your money and in return give you a piece of ownership. The other thing that they do is debt. They incur debt. They borrow money. When a company borrows money, again, they just have to pay it back. So it's just debt. No ownership changes hands. How can they do debt? They can maybe take out a mortgage on their buildings, on their plants, on their machinery. Maybe they could just go to the bank, take out a loan. Those things work. Those things have their place. But when a company needs to raise cash, especially a great deal of cash, they will often go to the bond market. And in the bond market, they sell bonds, and typically the bond then is going to be more of a long-term instrument. It's an IOU. If you're an investor and you give me, the company, some money, I'm going to give you a bond in return, and that bond is nothing more than an IOU. That IOU says I'm going to pay your money back in a certain period of time. And along the way, I'll give you some interest. So let's say I am a representative of company XYZ. XYZ wants to sell bonds. And we need to raise the money, so we have this bond sale. And bonds typically come in $1,000 increments. Unless it says otherwise, when you say you're going to buy a bond, that means you're buying $1,000 bond. So they're going to issue me a certificate. It's going to look something like this. It says XYZ company is going to pay $1,000. We could say this is the par value or the face value, but the value of this is $1,000. I am going to give them $1,000, and then they're going to pay it back. So there's an issue date and a payable date. The payable date is also the maturity date. When are they going to pay that money back? In this particular case, hopefully you can see this, it's being issued on the 1st of September 2020, and it's payable, or it matures, on the 1st of September 2025. So this is a 5-year bond. And again, bonds can be very short-term or they can be very long-term. You can have 10-year bonds, 30-year bonds, 50-year bonds. I even at one point in time bought a 96-year bond from the Halliburton Company. So they are then, after 5 years, in this particular example of a bond, they're going to pay me back my $1,000. Now, along the way, they're going to pay me interest. Bonds typically are a pay-as-you-go income stream. And so the interest rate here on this particular one I'm showing you is 10%. So they're going to pay me each year 10%. Now, since it's $1,000, 10% of that is $100, so I'm going to get $100 every year. Now, they can pay me once a year, or they can pay me once a quarter, or once every 6 months, once a month. It's all in the terms of the bond. But usually, the usual bond will pay it every 6 months, or semi-annually. So if this is a normal bond, they are going to pay me 1/2 of that, or $50, every 6 months. So in this case, it says down here, it's going to be paid semi-annually, and it's going to be paid then, since this bond started in the 1st of September, they're going to pay me at the 6-month mark, which is the 1st of March, and then again and the 1st of September, and it's going to go on every year, every 6 months. On the 1st of March, 1st of September, they're going to give me $50. So for a grand total of $100 a year, which makes that the 10% interest rate. Well, bonds today are all computerized. If I went out and bought a bond, I would not see a certificate like this. But many years ago, before we had computers, we gave out certificates, or the companies gave out certificates. And again, they didn't have computers to track the interest payments. So typically what happened is you'd get the certificate, and then there would be these little tear-off perforations, which they called coupons, that were part of the package that they gave you. And after the first 6 months, I would tear off this first coupon, and that coupon says payable for $50. I would take it down to the bank, I would give them the coupon, they would give me $50. The next 6 months, after 6 months, I'd tear off the next coupon, I'd take it to the bank, and so on. Every 6 months, I would take a coupon, take it to the bank, I would get my money, and then finally, when the very last coupon was due, I would give them the last coupon, they would give me my last $50, and then they would give me my $1,000 principal back. So, because of the fact that they used to call these coupons, that's where the term coupon rate came from. The coupon rate is just merely the interest rate that they're paying you. But this is a term, coupon rate, that just was from the old paper and pencil days, and it's stuck because that's what they called it back then. So when you hear the term coupon rate, that's essentially all that's saying is that's the interest rate for the bond. Okay? So, note again, what are some of the things? Who's the company that issued the bond? How much is it for? It's typically $1,000. That how much of it's for, we're going to call that par value. We can also call it face value, but this bond is worth $1,000. It's going to be payable on a particular date. That is the maturity date. And then they're going to pay me as they go an interest rate that's called the coupon rate. And how often they pay depends on the terms of the bond, but normally it's every 6 months or semi-annual. So I own this bond. Let's say now I'm an investor. I purchased one of these bonds for $1,000, and I can hang on to it for 5 years, collect all the payments, and then get my $1,000 back. Or, if I need to along the way, I can sell this bond to somebody else. So what's it worth? It's worth $1,000, unless something in the environment changes. So what I'm paying for is the income stream, the amount of interest that I'm going to receive. And as long as the environment is the same as when I bought it, the value of this is going to stay at $1,000. But things don't stay the same. Things change. Interest rates go up and down. The risks of the markets go up and down. So things are going to change. So let's just suppose that I want to sell this. I'm a year into it. And I want to sell this to another investor, maybe Fred over there. I'll say, Fred, I heard you're looking for a bond. I've got a bond here for sale. It's a $1,000 bond with a 10% coupon. And Fred will say, okay, I'm interested in buying your bond, but wait a minute. Interest rates are no longer at 10%. Interest rates have gone up. They're now at 12%. He says, why should I buy this bond from you for $1,000 that only gets $50 every 6 months, when if I were to buy a brand spanking new bond today, I could get $60 every 6 months. I'm getting 12% instead of 10%. So, no, I'm not going to buy your bond for $1,000. That would be crazy. So I'm going to say, well, okay, I understand that the interest rates went up a little bit. Therefore, in order for you to make up the difference, I'll discount the price of this bond. Instead of giving it to you for $1,000, I'll work out the math and figure out, well, maybe this is worth $950. So I'll say, okay, Fred, here's a $1,000 bond. Will you buy it from me for $950? And Frank will work out or Fred will work out the math, and he'll say, okay, yeah, that works out fine. So I will give you $950. So what did we see here? Even though everything is the same with the bond, nothing has changed. It's still worth $1,000 on this particular date. It's still going to give me an income stream of $50 every 6 months. This bond is now worth a little bit less because interest rates went up, because you could buy a better deal if you bought brand spanking new. That's why when interest rates go up, the value of bonds go down. They're inversely proportional to each other. Similarly, let's say Fred wants to buy a bond, and I've got this one for sale, but interest rates have gone down. So if he were to buy a brand spanking new bond today, he'd only get 8%. And now he'd only get $40 every 6 months. So he'd say to me, hey, Professor, I'd like to buy your bond. I'll give you $1,000 for it. I'm going to say, well, wait a minute. The interest rates have gone down, so you can't get as good of a deal as this. If you're getting $50 on here, so if you were buying a new bond, you'd only get $40. So this is worth something more than $1,000. This is a premium bond. I need to get a premium. So we'll both work out the math, and maybe we might figure out that, okay, this bond is worth $1,050. So now he'll give me $1,050 for the bond. And again, that's an example. When interest rates go down, the value of bonds goes up. So from these examples, we could see that we have an inverse relationship between interest rates and the value of bonds. So I'm going to go ahead and I'm going to sell him the bond, in this case, for $1,050. If you're an investor, though, there's one other little thing you need to keep in mind is, let's say we're halfway in between the periods. I'm selling this halfway between March and September, so this will be at the end of June. Well, I have really owned that for half the period of this next coupon. And I should really have $25 coming to me because I was the owner of the bond for half of that time. Well, the company doesn't care. The company's just going to pay whoever owns the bond on the date that the payment is made. So there'll be an additional $25 that'll be kicked in just for accumulated or accrued interest. So he would give me $1,050 for the bond, and then he'd give me $25 for accrued interest. So I'd actually sell this for $1,075. And on my taxes, I would have a $50 gain, capital gain on the bond, and I would have a $25 interest. So that is how bonds are valued according to interest rates. But there's another thing that affects the value of bonds, and that's the risk. This bond is worth $1,000 in 5 years, regardless of what happens in the economy. The exception is if XYZ Corporation goes bankrupt. If they go belly up, then I'm going to lose part or all of my $1,000. So as long as the company remains solvent, we're good. But if that company goes under, now my investment is at risk. So there are a couple of companies that look at the financial strength of corporations as they put out bonds, and they will give them ratings based on their risk. There's two main companies that do that. Moody's is one, Standard & Poor's is another, and they will give a grade to the XYZ company's bonds. And if this company is in a very strong financial position with virtually no risk of going out of business, they're going to have a good rating It'll be like AA or AAA. The different rating companies use just a little bit different terminology. But if you see A's and multiple A's, that's a good thing. On the other hand, maybe this company has some risk of going out of business or taking a big hit, so they're going to have a lower rating, B, C. Those companies that have the best ratings are going to have preferential treatment on the coupon rate. If your risk is not as high, your reward is not going to be as high. So maybe 10% is the average, but let's say XYZ has a really, really good record, a good risk rating, then maybe their interest rate that they can demand is going to be a little bit less. Similarly, if your company is riskier, you're going to pay more for that particular risk. And let's say something happens along the way. A couple years into this, something happened to where now this company was no longer, it wasn't 100% sure that they were going to be in existence on this maturity date. Now, if I were going to sell this to Fred, say, Fred, I'll sell you this for $1,000. He'll say, no way, I don't even have confidence that that company's going to exist at the maturity date. So I'm not going to pay the full $1,000 for it. So I'll say, okay, well, will you give me $800 for it? And he'll determine the risk and what the risk-reward ratio is for him. And he'll say, okay, I'll give you $800 for this. So in this case, the bond was discounted, not because of interest rates, but because of risk. Okay? When the companies have a very low risk, they have a good rating, that's called financial quality bonds. And those are good bonds to hold. On the other hand, when it gets down to the lower end of the spectrum, we call those junk bonds. And when you are a junk bond, you're going to pay a penalty as a company because you're going to have to pay more interest than anybody else does because you have a poor credit rating. So if you have ever heard of something like junk bonds or high yield bonds, high yield is one of those politically correct terms that they use for junk bonds. If you've ever seen a high yield mutual fund, bond fund, that's what it is. It's junk bonds. And junk bonds, as an investor, can pay pretty well. They've got better than average interest rates, and you can do well. The problem is, every once in a while, one of these guys are going to go belly up, and you're going to lose that whole investment. So junk bonds, you're going to do well, but every once in a while you get a default, which kind of balances everything out. So be careful about junk bonds and junk bond funds. Junk bond funds, though, are less riskier than owning a fund because they own so many different bonds that if one or two goes default, it's not as big of a hit as if you were an individual holder of the bond. So when we determine what a bond is worth, there's a couple things we have to keep in mind. There's two pieces to this. Number one, what is this $1,000 worth on this date? Okay, on the maturity date, it would be $1,000. So that's a future value. We have to take that future value and convert it to a present value, and we're going to have what's the present value of this $1,000 on this date. And there are formulas to do that. The second piece is what is the present value of this income stream. This income stream is an annuity. We're going to get $50 every 6 months for 5 years. What is the present value of that stream? So we take the present value of the bond, we take the present value of the income stream, we add those things together, and that's going to give us the total present value of the bond. So there's some problems in our homework that we're going to be figuring out the bond value, and those are the two things that we have to look at. Okay? When we take the entire value of it, and then what it's going to be worth, we can take and calculate what's called the yield to maturity. The yield to maturity is an annualized number that is the value, the rate of return we're going to get back, the yield we're going to get back on the package of the bond plus the stream. Okay? So if you want to buy a bond as an individual investor, you can very easily do this. If you're not a heavy investor, you probably don't own any bonds. If you do, they're in mutual funds or ETFs, or maybe part of your 401k. But if you want to buy an individual bond, it's very easy to do. If you have an account with a major brokerage, a Schwab, a Fidelity, TD Ameritrade, any of those, you could go buy individual bonds. You can do a search on bonds by their rating, their risk rating, by their company, by the yield to maturity, and you just pay them whatever the bond is worth at the time, because they calculate the present value, and that present value then has these two pieces, and they figure out what's the yield to maturity, and they'll list that, and then you'll give them whatever money that they are asking for the bond. So it's pretty easy to do. It just goes into your account. Every 6 months, this coupon just automatically shows up in your account, and then at the very end, $1,000 just automatically shows up in your account. So they're instruments that are very, very common. In fact, the overall bond market is more valuable than the stock market. It's just that the stock market, we hear that in the news all the time because trading happens so quickly. There are traders that go in and out of stocks in a matter of seconds. They'll buy some stock, and then 1 or 2 seconds later they'll sell it. Just they're very, very short-term oriented, and stocks move very, very quickly. Bonds, on the other hand, move slowly. So there's not as much trading. It's very rare where somebody buys a bond and then sells it, the same day. So bond market is not as volatile. Bond market, there's not as much activity. But as far as the total value and volume of what's out there, the bond market is actually bigger than the stock market. I'd like to share just 2 more items, and those are 2 variations on this. Okay? One variation is called a callable bond. That's where the company reserves the right to pay you back early. Let's say that this matures in 5 years, but it's callable after 3, which means after 3 years they can cash you out. Okay? That's a callable bond. Now, companies will want to do that because if interest rates go down, for example, and they're still locked into a higher rate, they would like to be able to refinance. Kind of like, if you financed your home at a high interest rate, a high mortgage rate, rates come down, you would just as soon refi. So that's what the company wants to do. They want to refi, okay? But they can't do that unless it actually says that in the bond. The bond will say it is callable. Now, companies like that, investors don't like that. Investors don't like it because they want the certainty. They want to know for certain when this bond is going to be called, because it's too hard to determine what the value is if we don't know the history, well, the future history of what's going to happen to this. So in that case, the company really, in order to get investors to purchase a callable bond, they have to sweeten the deal a little bit. They have to make the interest rate a little bit better, or maybe they'll have a prepayment penalty that says we'll cash you in after 3 years, but if we do that, we're going to give you 1 extra year's worth of coupon. So companies have to do something to sweeten the pot otherwise investors, they're not going to want to buy callable bonds, okay? And in order to figure out what the bond is worth then, we have that yield to maturity. What's it worth according to the maturity date? But on a callable bond, there's one more one we have. It's called yield to worst. That says if they cash it out on the date that they say that they're able to, what are the numbers according to that happening? So that would be the worst case scenario for the investor. So we're going to figure out some new ones, yield to worst. So that's for a callable bond. The other type of bond is called a zero coupon bond. Zero coupon bonds, more than anything else, are for shorter term bonds. It happens with long-term bonds, but not as often. That's where they don't pay you anything along the way. Just they pay you back. But in order for that to happen, they're going to have to sell you this discounted. So in this case, if this was a $1,000 bond for 5 years and it was zero coupon, we'd have to determine just this piece. What's the present value of just this piece? Let's say it turns out to be $900. So they would in turn sell me this $1,000 bond for $900. I'd give them $900 now. They give me $1,000 in the future. That's essentially how Treasury bills work. But those are more short term. And you know it makes sense on the short term, because why set up a coupon payment thing if this thing's only going to be around for a few months. So that in a nutshell is bonds, how they work, and as an investor, it's something to consider. Right now, bonds are well, the interest rate. I'm making this video in the summer of 2020. Interest rates are really, really low right now, and there's really no downward motion left for them to go. So for a long-term bond, it's kind of risky, because remember, if interest rates go down, the value of the bond goes up. But interest rates can't go down much farther. They're already at the bottom, so there's not a whole lot of upside. On the other hand, there's a lot of upside to interest rates. Interest rates could go higher, which means the value of the bonds could go lower. So interest rates, at least for long-term bonds, well, the value of the bonds based on where interest rates are today, long-term bonds are a bit riskier. You could lose money, and a short-term bond, though, in the short term, things don't change as quickly. And this $1,000, if you have to discount it 30 years, you're going to have a very, very small number. But if you have $1,000 and you're only discounting it over like 6 months, or maybe even only 1 year, it's not going to be that much less than $1,000. So short-term bonds are not as risky in an environment like we have today. Those are the things I had to share with you, and hopefully you have a better understanding of bonds and how they work. And have a great day, everybody. We'll talk to you later.